Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
Don't know, John. Market's barely moved this week.
Nah,
I'm not sure we should bother.
Yeah.
I don't know what's going on.
Should we wrap it up there?
Yeah.
Aye, be fine. See you next week.
The thing is that actually markets have moved quite a lot. It's just that there's not that much that we can add to the fact that they have moved quite a lot, right? Up, down, all over the place. And the only way you could really say something sensible about this is if you had the faintest idea how long this new war in the Middle East would go on for, and we just don't.
Yeah, and that is specifically the point, because the length of the war means the length that oil prices are elevated, and that then has the knock-on effect of, is inflation going to be actually significantly higher than everyone had thought up until about 2 weeks ago, and therefore interest rates higher. So it's a big deal. It's got a lot of big potential consequences, but unless you've literally got a crystal ball, then there's no way to say what those consequences are going to
so
be.
We can have relentless conversations about how many days worth of oil reserves every economy has, about who is the most reliant on oil from the Middle East, Korea and Japan, by the way, and which markets therefore should suffer the most over the long term as a result of the war dragging out or not dragging out. But in the end, it comes down to, well, we have absolutely no idea, and we will find out in the fullness of time. But I suppose what we can talk about is the way in which this war and the immediate energy crunch that it has resulted in shows us the vulnerabilities in developed economies in general. I know you've written this week about the vulnerability inherent in the UK economy, and it just reminds us that we're in a global economy that has fractured, and that makes every problem about supply.
Yeah, I think that's a really good way to put it. I mean, we've seen this. I mean, I guess this has been coming for quite a while, and people have been worried about, the fracture in the supply chains. Obviously, COVID made it very obvious how vulnerable we are and how reliant we are. But unfortunately, in the UK, we haven't really done anything about that. And energy specifically, obviously, is a big issue. But as Simon French, a podcast regular from Panmure Labour Room,
please go back and listen to the podcast we did with him recently on MMT.
Yes,
very interesting.
Do
worth listening in particular now.
Very timely at the moment. But the thing, Simon put out a piece this morning called Ration Pack Britain. It kind of inspired title, really. And what he's saying is that the big thing behind the UK's productivity puzzle, as in the fact that we don't seem to be getting more out of what we're doing, is that it's not actually a puzzle at all. It's very clear what the problem is, and it's because we've been rationing the supply of three big important inputs, and that's energy, land and capital. So everything's more expensive than it should be. Most of this arises from, you could call it well-meaning. I think stupid is a better word.
You can be stupid and well-meaning.
Yeah, exactly.
But in the end,
well-meaning is not a good excuse for being stupid.
And well-meaning kind of disappears after it's been explained to you a certain number of times.
Exactly. So the fact that we've kind of cut off various sources of energy to ourselves, the fact that you can't, build a house or anything else in the country without, jumping through millions of hoops, and the fact that we've kind of sabotaged our own capital market by getting rid of tax breaks for investing locally and keeping them for investing wherever the hell you want hasn't helped any of this. And so Simon's point is, well, actually, most of these things are actually reversible. If you had a sensible government in power, then you could change all these things. And it's not the current government's fault. The current government has compounded it with even dafter policies and Labour and all the rest of it. But, it's, this all happened under, the previous kind of like the Tory government and even going back before that. So I guess the only way that it does change is if voters start to wake up to and demand change. I mean, the North Sea oil is a good example. Rachel Reeves seems to be kind of thinking about maybe reducing the ridiculous tax rate on North Sea oil exploration, but we're still not there yet. Just do it.
Yeah.
It's straightforward.
Well, it's interesting. I mean, they said, didn't they, today or earlier this week, that they're working on looking at ways to. Like, how hard can it be? How hard can it be? You don't need to look at ways to. You can just cut that tax or take that tax away. Sometimes
Focus
they forget they're actually in
first.
power, I think.
Yeah, I think they do. Increasingly, they all seem to not realise that this is actually their job now.
I mean, there was something on the radio this morning. I can't even remember what it was about, but I was listening to some minister or the other, and the interviewer said to him, "Well, are you going to do this particular thing?" And he said, "Yes, no, parliamentary time allowing." And I'm like, you're the government.
Exactly.
Make for parliamentary time. And this is another one of those things. You want to do it, or why don't you just do that?
Yeah, and I mean, you can see why people get frustrated. I mean, there was it's a daft example. And it wouldn't draw attention in different times if it wasn't for the fact it's such a big metaphor for what's going on with our governance right now, which is that a load of MPs were pictured taking part in some Strictly Come Dancing thing, which was kind of meant to be a focus on how exercise is good for you or
Some of
whatever.
them are quite good at dancing.
I'm sure they
Some
were.
of them are really bad.
Well, maybe I'll go back and watch it. But there is an element of fiddling while Rome burns that's very overt and kind of, it's just, regardless of whether it was actually a perfectly reasonable and sensible use of parliamentary time.
There's really important stuff going on, and we'd like you to do that, not dance.
Exactly.
There's a time for dancing. There's a time for doing. Yeah. Listen, this all comes
You should
back.
copyright that. That's good. That's catchy.
Do you know I will? Yeah, we'll put it in our marketing. This brings us back to a podcast that we did with Callum Pickering a while back.
Yes.
Do you remember this? About a year ago.
Yeah.
And I can't. He had a paper out called "Does the UK Lack the Energy for Productivity Growth?"
Yeah.
And the chart was just so startling because at the time, and even now, lots of people believe that the UK's productivity problem started in 2007, 2008, so after the GFC. And his work and his charts said so clearly that productivity started to fall at the same time as the UK's electricity supply started to decline.
Yeah.
And that was in 2005, 2006, early 2006. So with the fall in supply of energy came the general flatlining of all productivity.
It is. I mean, to be honest, that might be the most important chart of this millennium.
Yeah.
Because I remember your most important chart in the world used to be the Bank of England forecasted what would happen when interest rates went back up and inflation.
Well, what was that 3,000 year chart of just showing them, being ridiculously low relative to 3,000 years worth of history.
Yeah.
And then I went through a phase of saying, well, the most important chart in the world is now the one where it begins to tick up.
Yeah.
Because we've got used to the idea of what happens when interest rates are below zero or zero. We now understand the consequences of that. What we don't understand is the consequences of rates ticking up very sharply and moving into a new 40-year interest rate cycle where they will be consistently higher than they've been in the past. And interestingly, I thought that would happen reasonably quickly. I thought the consequences of that shift in the interest rate environment would be seen in a year, 18 months or so. But actually, it's taken a lot longer, but we're seeing it now, right? And we're seeing it, for example, in the private credit market. Lots of our colleagues will have written about that, but you're seeing fund after fund after fund saying quite a lot of nasties in there as the private credit environment begins to see defaults, write-downs, mini collapses, etc. So that's in there. And as Edward Chancellor, another regular on the podcast, as he always says, super low interest rates, they get into all the cracks. Yeah. And you don't know what the consequences are going to be until quite a lot later. And I think we are beginning to see some of those consequences. And going back to neither of us knowing what on earth is going to happen with this war, one thing we do know is that even if it stops very quickly, it will still show up a little bit in CPI. It will still make a difference to the easing cycles. And the assumption that the next rate move in the UK will be down is pretty much already done for, isn't it? So I
think the assumption there were going to be two cuts. I think that there's still assumption in the market that there will be one cut this year. But you're right. I mean, that could change.
It could change. And there is not the real risk here is stagflation.
Yeah, I mean, stagflation, and that would be a nightmare given that we're already borderline stagflation in the UK anyway.
Well, we're stagnating. I mean, that's pretty clear. If you get to the point where we're muttering about, isn't it marvellous that GDP growth is going to be 1.1%? I mean, this is not exciting to me. 1.1% is very, very bad. And in terms of GDP per head, well, we all know where that goes. So, this is not good. The UK is stagnating. Yeah. And it doesn't take much to shift a stagnating economy with an energy crisis into stagflation. And that is what we are, a stagnating economy with an energy crisis. Oh, this is fun, isn't it?
Yeah, I think one of our readers was saying recently that we're a bit too gloomy. But I'm not sure what else you can
Good challenge,
be.
John. End this podcast optimistically.
It could help you over by Christmas.
All right, that's it. I'm calling a halt to this podcast. That's really all we can say for now because, as I say, there's much volatility in markets. There's a lot of emotion in markets. There's a lot going on with both energy and with the whole AI conversation we've had over and over. Lots to think about, lots to talk about. Don't forget that we both write newsletters trying to analyse some of these issues, and hopefully things will become clearer over the next week or so. Thank you, John.
Thanks, Merryn.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to your podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. John is really going for it on Twitter at the moment, by the way. Well worth following if you don't already. I'm at Merryn SW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Society and Moses and